Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551, or you can email us at info@yourmoneyontap.com. This is Ben Brayshaw, and I'm joined here once again with Dan Michelon. How you doing, Dan?
Doing great. Happy to get through tax season here.
Almost done?
Almost there.
Been a long few months, Dan. More so for us than the listener. You're listening to Money on Tap. We appreciate you joining us today. We have a very interesting show, something I think is going to bring real value to our listeners. We're going to talk a little bit about things around stocks, events that occur with stocks. And we're titling this show, Stocks You Buy and What They Do. And I think what's really going to bring value to our listeners is really understanding the intricate events that occur around stocks, what they mean, some of the items that people talk about stocks on, right? What their yield is and PE and all these different kind of things, and then what the corporate actions are. So there's a lot of moving pieces here that are really becoming much more relevant to people who own just straight up equity, straight stocks in their portfolio, because all of a sudden something happens in your portfolio and you said, what happened there? And you're calling your broker or you're asking what's going on. But a lot of companies are taking a lot of really direct approaches to making moves and buybacks. We're going to talk a little bit about buybacks and what's going on there. So you have any thoughts on that?
Yeah, I mean, I think the news is ever increasing because of social media, our access to news. So people are starting to pay more attention, and we realize that in the questions we get. So a lot of what's gone out there and is made public, and the kind of ever-increasing transparency of what a publicly traded company needs to do triggers a lot of questions, and it sometimes concerns. So what we wanted to do is take some time with the show and kind of define terms for you, give you a better understanding as to what some of these headlines really mean. Because as a stockholder, you do have, believe it or not, voting rights that the board of directors needs to pay attention to. It's amazing at times what just a handful of stockholders can do that would influence a board's decisions in significant ways. And we're going to get into some of that, some examples.
Yeah. And I think this is going to be valuable, especially a lot of our millennials that may not even have as much exposure to all the corporate events that occur that you have no say over even, honestly.
Right.
And so that's really, really important to understand what's going on and how that might impact both the stock in a positive and a negative way. We're going to kind of cover both of those too. For our listeners, people have inquired a little bit about Seth and what's going on. But Seth is doing well in recovery. He's working through some of the struggles of that. We're excited to hopefully have him on the show sooner than later. Thank you for your prayers and your thoughts. It's really been nice to hear from a number of you in that capacity. I know he has appreciated that as well. But before we jump into our show, we have, as we usually do, we have money in the news. Probably the first corporate action that would bring the most relevance to money in the news today, I think, would be Elon Musk's purchase of Twitter, the 9.2%, Dan.
Yeah, it's an absolutely huge number, and I was shocked to hear it, particularly because he's been fairly critical of Twitter on Twitter and in the press, which is interesting. But, it wouldn't be a show without a little bit of Elon Musk going on, right? I mean, the guy makes news every week, that's for sure.
Well, when he puts Trump back on there,
yes,
he's definitely going to make some news. Oh,
that'd be good for the stock price.
That'll definitely be good for the stock price. I'll be turning my Twitter account back on.
Yeah, maybe that's his play, quick dip in and make some money here. But it's a sizable position he took. I mean, they didn't say what price he got it at, but his stake was worth $2.9 billion as of the close of trading on Friday last week, which is really incredible, and it was up to $3.5 billion actually by Monday. So if you follow the stock or own the stock, you've seen this tremendous swing in price, and really it's been driven by this.
Absolutely. And, I think the thing is, this article is a CNN article by Chris Isidore, and he talks a little bit about the fact that, and I think it's important because it's, you can't just buy 9.2% of a company and all of a sudden, ding, 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 it's like, I own this. There's actually a filing that's required, and he brings that out, that, once an investor buys 5% or more of a company's shares, they got to disclose it with certain filings with the SEC. And that's just, so this isn't completely like, it's more of a shock to the fact that the filing occurred and, oh, wow, it's 9.2% he bought.
Yeah. That kind of a sizable position becomes news and it goes public. He's, he didn't do this on E-Trade. That's
He didn't do it on E-Trade. It is still considered a passive position because it's under 10%. So I wonder if there was some strategy around that.
Yeah, I think we're going to dip into that a little bit when we start talking about, insider buying and selling. In kind of what the disclosure requirements that come along with that, what it's considered and what it means. But what was interesting, too, in the article is that he owns 9.2%, but the Twitter CEO actually owns about 2%. So he's taken 4 or 5 times the position that the CEO actually holds.
That is interesting to me. I also don't think much of the CEO myself, but add him to my list of disparaged.
It'll be an interesting board meeting next time around, though, wouldn't it?
Definitely want to be present.
That might be the first and only one I ever tuned into. But.
That would probably be the only one I would fly out for my proxy vote.
I don't even own Twitter, but I might buy a share just so I can show up.
Just so I have an entry. I want to place my one vote. I think one of the things that was brought about, and I think this is an important piece for people to understand, that we really play a much smaller role as investors in this world when it comes to a company like Twitter now, right? Elon Musk has a 9.2% vote essentially on what's going on and who becomes a board member even. There's a lot of moving parts around that. But I think the article brings out a really good point that a lot of listeners probably aren't paying attention to, but it creates 2 problems. One is that you're potentially bringing on another passive investor, somebody else who might want to get in to really push the board to do whatever they want. An opposing investor might create even more problems. But this might just set Twitter straight. It might stop them from the level of censorship that I think that they've enjoyed for the last couple of years. But the other piece that I think is really interesting is they talked about the idea that this might kind of put aside the idea of like Trump opening up a new platform himself. The fact that, if all of a sudden the more monetized platforms that people are more comfortable with, used to, have used, might say, hey, Trump's back on. I'm just going to go there. Why bother with another platform?
You think there's got to be some mission in mind that he's got here. This isn't just a stock trade, so he's got some change, in his vision as to what's going to be the future of Twitter. And, maybe it's that, maybe it is the kind of woke censorship that he's tired of and wants to do away with. But we're basically going to have to wait and see.
I think that's really what it is. I think you make a good point there. You don't make a $2.9 billion stock trade like this and think it's just meant to be temperamental. As hey, listen, I think Twitter's down today. Let's buy 9% of the company.
That's not buying the dip.
Yeah, no, exactly. You want to take the next one, Dan?
Sure. So next up, we get an article here out of Fox Business. Billionaire supermarket owner warns food prices continue to rise for the next few months. This article is by Talia Kaplan, and concerning story for sure, concerning headline. And you would think this gentleman's kind of in the position to know. He's the owner and CEO of New York supermarket chain Gerstedes, which I'm not sure if I got that right. But, he's looking at or predicting another 10% increase in food costs over the next few months, which, given what we've already experienced, and we've talked about that, milk and eggs and, who knows what, everything seems to be going up regardless of what it is. But 10% additionally from here just sounds painful.
I was actually talking to this one gentleman today. He's like, yeah, I built a little greenhouse for my wife and family and stuff like that. I was like, oh, yeah, how big? He's like 17 by 90 feet. I was like, that's not a little greenhouse. No. He's like, well, I got 5 kids. But people are taking real steps to address the food problems. Because it's just super expensive. And I don't know if when we talked about this last week, there's shelves empty at Hannaford. I was like, what's going on here? But I also think that what was shocking was the amount of food that, I literally was walking by food that was rotten on the shelf. I was like, they're not even taking it off. It was the only one of two peppers that was in like a thing, and it's just like left there. It's just there's just so little of it that maybe someone will buy it, I guess.
I mean, I've noticed them shutting down like the deli and the seafood section early. It used to be at like 8 o'clock, maybe an hour before close, they'd start pulling everything off. But now you go through there, after that kind of after work rush, by 5:36, they're already closing down.
Yeah.
It's incredible.
Yeah, it really is. It is really concerning, and things that I think, we bring to the table a number of different conversations here, and one is take care of yourself, be ready for this, because there's something coming. And I think that's probably as apparent as it's getting. And no matter what we're doing, we were talking about this pre-show, the oil and gas problem's far from over. We got years ahead of us.
And that leads right into what the suggestion is the only way to potentially fix this problem that the CEO mentions is to reverse course on the energy policy here and open up North America. His position is that we can be once again energy self-sufficient, and if so, that would drive down food costs immediately.
Yeah, I think the thing is I've heard a number of different articles. Obviously, we do a lot of oil and gas investments in all sorts of areas. We've sold simple ETFs in that space at different times over this past year. In the last few years, we've been heavy in that space. CNBC. This article talks about the Federal Reserve. It's by Joshua Roberts, I believe, is the article. But the Fed raised rates about 1/4 point. And then with this oil and gas trouble, I heard that if we opened up drilling on federal lands again, it would probably drop $20 to $30 per barrel of oil.
Yeah, and then jumping back to that previous article, I mean, his suggestion is, and he's a grocery guy, so I'm not sure how well vetted this is, but he thinks by reopening the North American oil agreement, we could produce 15 million barrels a day.
Oh, yeah. We wouldn't even be talking about using our emergency reserves. I think that's foolish. I mean, we need to, if shutting down a pipeline on Russia is going to hurt their economy, how does shutting down the pipeline help our economy, right? That's the meme I've seen 15,000 times on Twitter. Not Twitter, Instagram. They talk, it's like all these different rigidities that they're trying to enforce on Russia. Well, they're things that we're actually enduring and watching our oil prices rise.
Self-imposed.
Yeah. So the Fed's raising of rates is 25 bips or 0.25% this last month here. There's the expectation that this coming month and actually this month and next, there might be 2 50 basis or 2 half-point hikes on rates, which is astronomical, honestly. And, to see a whole 1% raise, I mean, that's literally, you could translate that to, hey, your mortgage is, if you're applying for a mortgage 2 months from now, you're going to be looking at least 1% higher than where you're at today for an application. I mean, that's really what we're considering as an issue here. So there is a real direct impact to this. The idea of raising rates is to ultimately slow the economy, reduce GDP, reduce demand, and ultimately push down the demand. Therefore, the inflated prices then decline. There's a lot of speculation, Dan. Do you want to jump into that about whether this will work or not?
Yeah, I mean, that's the methodology, and that's kind of why we went into the article is we see this a lot. Well, inflation's high, so the Fed's going to raise rates. And you may think, well, if inflation's high, why would we add extra interest to all of our purchases? It seems a little counterintuitive, but that is, to Ben's point, what they're trying to do is slow down the economy and limit demand. But the downside to that is if a company feels as though there'll be less sales going on because they're a price-sensitive entity, whatever it is they produce and sell is sensitive to those things, well, they're going to stop investing in research and development, so there'll be fewer new products rolling off the shelf. And they may very well cut jobs, put people back on the street, and increase unemployment, which is generally never good for an economy.
Yeah, and I think the idea of inflation and monitoring inflation and trying to push it down and raise rates, if an economy has so much demand that everyone's fighting to buy everything, therefore everyone's willing to pay a little bit more because you want it so bad, the idea of raising rates just creates higher costs, and therefore, somebody's going to say, you know what? I don't need that in life. I'm going to move on. Like if a TV is $25,000, well, you know what? I'm going to see if I can find something at the dump. There's just a price level where people don't buy. I think the thing is, and I personally think this is going to backfire in ways we're not even prepared for. I don't know how bad or how it might even directly or indirectly affect anything specifically because I'm not an economist. But in a traditional raising rate scenario, the demand's so high and things are moving so fast because the economy is in a normal pace, but the pace is speeding up. But the truth is that we're trying to fill demand that was where factories were shut down for 2 years. This is old demand,
and it's artificially created. It wasn't kind of a natural economic cycle. It was nobody's doing anything for 6 months.
Yeah, or even a year. I mean, it's like some of these. I mean, China's shutting down again over BA2 or 3 or whatever. And I'm looking at this and saying to myself, it's not like the demand was unnatural. It's like like it just. I'm sorry that it was just a natural fly, and we're rising, and everything's just growing so fast that the economy can absorb these higher rates. The truth is that I think. There's two issues going on. One is the Fed might see this as an opportunity to get rates up, so they have more of a lever to play with, rate wise, because they have no lever right now. It's
at zero, pretty much.
Yeah. So by raising the rates, they can lower the rates in the future. I think they're seeing this as an opportunity for that. But honestly, what they're really doing is, I think the demand's already there. People are trying to fill orders that were already there. People have contractual sale prices that they have to hold up. And it's these increased rates are forcing things to be more expensive beyond being more expensive.
Yeah, and a major portion of the inflation we're experienced it's just in a couple of areas, right? If you took the food inflation out and took the gas and oil inflation out, we'd be in a slightly inflationary time right now, but nothing like what we're actually experiencing. So you'd think there may be some better levers to pull, or we talked about gas tax relief and just different ways to adjust the price on those specific items and then let the economy take its natural course from there.
Yeah, I agree with that. I totally agree with that. I mean, I think we need to I think the Biden administration needs to simply just ease all the oil and gas programs to allow that to naturally deflate there. Raise your rates accordingly, and they kind of offset. You rebuild your lever in the rate space. You've kind of curtailed a little bit of the inflationary costs of food and transportation and so forth. Allow people to finish off what they need to do to fulfill those orders, and then take your agendas for another run.
See where we're at that point.
Yeah, I mean, it's just don't agree with the agendas, but give us a little reprieve is really where that one piece is. I think Dan, the one I don't want to take away a little bit your steam here, but I thought it was interesting that the article compares the inflation to the chemo. Do you want to talk about that?
Well, the raising of the rates,
yeah.
Right? So the which was a kind of a stark comparison. It was interesting to read, but the intent of this is to essentially kill off parts of the economy, to bring us back to a place where things are moving at a more predictable pace for them. They target 2% inflation, which we've been below, but historically looking back, I mean, that's right about where we're at. But it just seems so strange that the path to a better economy is to damage it intentionally. And really, the hard thing is this Fed rate increase really impacts only one thing. We talk about interest rates here all the time, but it's just the intraday loan rate between banks, right? Mm-hmm. So that's the only rate that the federal government has the direct ability to impact, is essentially what banks lend money to each other for. Now that obviously trickles down and impacts everything from beginning to end, but when inflation is really confined to just a couple segments of the economy, you think you just go right to the heart of it and address those things there.
I would agree. I think this is unfortunately, it's just not going to work. I really don't think this is going to do anything other than hurt our economy. And I was thinking about just the restaurants, right? Like the inflated costs of food and oil and gas and everything else. It's like these poor restaurants have been through a horrible experience over the last few years. Very few of them have been able to remain open. And honestly, as they keep raising rates, it's so expensive to eat out.
No, it's just crazy.
There's the downward pressure on restaurants again. It's just like, we're not going to have anywhere to go eat. And honestly, trying to find a place to eat on a Friday or Saturday night because so few restaurants are available, right?
It's amazing to me because, we go through this. I mean, they're all packed. You can't even get in. And it ends up costing you twice what you used to. I mean, it's insane. I don't really understand it. But the fact of the matter is, I mean, these are the conditions, right? So there's got to be a better fix, I think.
Yeah. Well, candlelight dinner at home. That's going to do it for Money in the News. Thank you, Dan. We will be right back. You are listening to Money on Tap. We're going to talk about stocks you buy and what they do. You can reach us at 855-226-8551, or you can email us at info@yourmoneyontap.com. Stay with us. We'll be right back.
Ben, how often do we have somebody come into the office and they don't have a financial plan? And how critical is it for us to put the pieces together and make sure that their future, their retirement, is a successful experience? We talk about it all the time here at Money on Tap. If that's you, give us a call at 855-226-8551 or info@yourmoneyontap.com. Whether you have 100,000, 500,000, 5 million, look, folks, we have the right planner for you. Whether it's Ben or myself, Seth Krussman, we're here for you to get the plan together and make sure that that next step is right.
Now back to Money on Tap with Ben and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. Hey, if you have a show idea or you have questions that are coming up on your, on the different topics we do or something you'd like us to cover, we'd love to try to entertain that for you. You can email that to us at info@yourmoneyontap.com. If we select your topic, you'll receive a free gift, a little paraphernalia item from our Money on Tap store. So we'd appreciate that if you have that. As we get into today's show, I think this is going to be interesting. I mean, there's a couple of things we've already talked about briefly, but stocks you buy and what they do, and I think this is the part of where all of us kind of own stocks, and some corporate event occurs. And all of a sudden, you either have more shares, you have less shares, you all of a sudden receive warrants. There's all sorts of things that just happen. You have no say over it. Or sometimes you do have some say, or you get something in the mail asking you to do something or choose something. And I'm kind of excited about bringing some clarity to that, Dan.
Yeah, I think you were hitting on there. The one that any stockholders experienced, whether they paid attention to it or not, it's a different story. But it ties into all this, and that's, you've received a proxy, right? So you get something in the mail where there's some, you recognize the name on the envelope because you own the stock. You open it up.
Hopefully you recognize the name on the envelope, Dan.
Maybe you don't, but maybe you do. So you open it up, and you're basically, if you took any time at all to read it, which often I don't, to be honest with you, but you're presented with a choice of some type of a decision that's being made by the board of directors that requires shareholder approval, and oftentimes it's only respond if it's a no kind of a thing, or it's an election of a new board member when you don't know any of the names on there, and it's kind of insignificant from your perspective as an individual stockholder. But that's a board of directors at work, and that's the participation that comes with owning stock. You are truly fractional owner of the company if you hold those shares. So you have the right to voice your opinion when it comes to these things. And there's a couple different forms of corporate actions, and that's what these are all called. I mean, all the terms we're going to get into today are corporate actions, right? And there's mandatory corporate actions, mandatory with choice, and voluntary corporate actions that all of us as shareholders have some level of interaction with.
Yeah, and I think the thing that's probably the most confusing for most of our listeners, and if you've experienced this, which if you own a fair number of stocks, would be the mandatory corporate actions. And some of them are really great. I mean, you're like, hey, listen, you got a stock split, and Tesla went 5-1. And you're like, I got 5 shares for every 1 share of Tesla I had. Well, that sounds great. I mean, there's a number of different events that happen. The board votes on it. And they decide, hey, this is what we're going to do, and this is the move, and there's no, you don't have a say in that.
Yeah, I mean, the one thing that you hope is true is that the board, and we're going to talk about IPOs and taking a company public. But once they've taken that plunge, right, so it is a public company, their sole mission is to act on behalf of the shareholder at that point.
Right. And a shareholder is an owner. So the board of directors is acting on behalf of every owner out there. At that, an IPO, initial public offering, meaning we're the first public event and where someone can own stock in a company. We hear about IPOs all the time. Is it a good time to launch this SPAC IPO?
Right.
There's so much, if and or but around what that is. But the stock split is probably the most common. Now, you can have a stock split or you can have a stock reverse split. I think it'd be good for us to walk through that.
Yeah, there's a couple splits in the news, so that's one of the reasons I thought this would be a timely discussion. But Google just announced a 20-for-1 stock split that's going to take place in July. So if you owned one share of Google, you'll soon own 20. All right. So the significance there is that you're going to see the price of the stock drop on that day down to 5% of its prior value. Right? It's going to be worth 1/20th, but now you have these 20 shares in hand. And there's been examples of how that can work in your favor over time. They don't all just take off like gangbusters, but very recently, going back to the Musk story, he's going to come up a lot today.
Yeah.
But Tesla announced a 5-to-1 split back in August of 2020. At that point in time, the share price was about $2,200. After the split, it dropped down to $498. All right. Today, those stocks that split into roughly $500 shares are now worth $1,124 each, again, as of the open today. So if you kind of reverse that split, every share of Tesla prior to August of 2020 would have been worth $5,620.
Which is crazy.
It's incredible. So the reasons for a split, we can talk about that a little bit, is if you have a share price that just seems astronomically high, there's a couple of different ways that can work for you or against you as a company. And generally speaking, it may be an intimidating factor. So you always want to attract the retail investor. Small investors drive the market in a lot of ways. And so somebody who's interested in Tesla and just looks up the price may say, well, I'm not even going to start this account with $5,000. I can't even buy a single share,
right,
which would be a discouraging event for them. And as well on, even on the institutional side, fund managers, people who choose to make investments on a large scale, there's a psychological effect of that price. So the split made sense for Tesla at that point in time because they wanted to attract that retail investor because it was such a, he's in the news all the time. He's all over the place.
Every kid out there, Elon Musk is like their hero. He says he's more of a tame, I would say he's more of a tame Trump.
Yeah. Well, you sit down with somebody who's trying to start investing. Say, what do you want to buy? What's on your mind? Oh, Tesla. Well, yeah, it's $5,000. They'll be like, well, somebody else.
Well, I think for people who look at this, they might look at alternative ways to get into Tesla at that point. They might look at ETFs. They might look at mutual funds. And ETFs and mutual funds, they're culminations of stocks, meaning that they have exposure to lots of stocks by buying one ETF or one mutual fund. The difference here, though, right, is if you're a long-term investor and you just want to own Tesla and you're not into Rivian or what GM's doing or Toyota or some of these name brands that we kind of hear in that auto space, and you really just want exposure to that, and you can't buy it, Dan, for $5,000 a share, okay? Well, then all of a sudden you're then paying additional fees and costs in buying something that's monetizing lots of stocks in that domain or in a group of balanced fund or something like that. And you may not want exposure to those. You may really just want to own Tesla and GM, and you might say, those are the two companies I want to own, but I don't like Ford, or I have a personal issue with Ford, and that happens.
I mean, if you buy an ETF, I'm thinking of one that comes to mind that's very aggressively in Tesla, but it's still only about 9%. So 91% of everything else you paid for is not Tesla.
Right. And it does give people exposure, and we can work with people who want to get into that. But the reason these companies do splits, and Elon knew this, hey, we're going to do a split. There's even rumor out there they're going to do another split.
Yeah, well, the price warrants it again.
Yeah, I mean, $1,200 a share almost, and you're dealing with another issue. So I think that's the one piece that people are looking at and saying, if we make the stock affordable, the kids in Robinhood can go buy a share.
Right.
And if we can have 1 million kids buy one share and they're going to hold it because they love Elon Musk, well, that's just going to make the company more valuable.
It drives the price.
Yeah.
Amazon's another company that they've announced the intentions. I don't think they have a firm date on that, but they're looking at a 20-to-1 split. And in the meantime, right after that, they're going to do a $10 billion buyback, which we're going to dump into talk a little bit about why a company considers buying their own stock.
Well, I think there's another point to be made here into why companies don't split their stock on top of what you were saying. One of the things I heard of the point was Amazon was, Bezos didn't want the stock to move at rapid paces. He didn't want it to be a tradable stock. He didn't want it to be so inexpensive that all of a sudden everyone was trading it every day. If you have a stock that's expensive, you're less likely to go in and out on a more regular basis. You're more likely to just hold it as an investment. So there's more holds in the more pricey stocks per se. So, if you really want a stock to be traded or you think it's attractive from a popularity standpoint, you want to make it as cheap as possible because lots of people are going to buy into it that wouldn't before. But if you think of something as more like an Amazon, they figured like leaving our stock at that $2,000 or $3,000 range really allowed it to have more stability in its price value, which is a whole different game, right? That's more about the owners of the company keeping their net worth higher.
I think for a little while there was a little bit of an ego thing going along amongst some of these, kind of hotshot CEOs of some of those companies that got really hot with Google, Amazon, Tesla. They liked the big number, and I think that played a part in this. But on the flip side of that coin is the reverse split, right?
Yeah.
Some companies, choose to contract their share balance, and GE was a recent example of this. And it happens very rarely, particularly amongst S&P companies. But GE did back in July of 21. Their share price was at $12.69.
Yeah.
So they did an 8-for-1 reverse split. So if you had 8 shares of GE, at the end of the day, you had one that was worth right about $100. And some of the thought process behind doing that is, again, there's a psychological effect. People think of GE as a stalwart company. It's been around forever. And they look at the share price and it's $12, which is very modest. There's probably some negative opinion that will come out of that. But as well, when the stock, hits a really low value, which they might have felt they were in jeopardy of, once you get below $5 a share or
it's actually when you go below $10, it becomes 10. It becomes almost unbankable.
Yeah,
and there's a problem with that.
Yeah, and at the $5 level, a lot of funds and ETFs won't hold it.
And exactly,
so you trigger a sell-off just because of the value,
right?
Which the same companies it was the day before, but you could have this total free fall effect if all these institutional holders says, "Oh, we're below the line," per our prospectus, we can't hold that. You'd have a mass sale, and that could literally crash the company.
Yeah, I think that's really important for people to understand that a company being sold, sometimes doesn't have any relevance to its validity or worth as a company. Like the financials of a company may never change at all, but just based on its stock price, there's lots of moving implications of what it's valued at and what it where it can be placed. I think you make a great point. Some ETFs, some mutual funds, they might just say we can't hold that stock. It's under $10 a share. It's under $5. It's a penny stock. Even though the company. So these reverse splits bring value. Now, theoretically, you're still worth the same in the GE space, roughly. But I think just going back to the Amazon and I think Bezos and Musk scenario, these guys are launching rockets into space. There's no question these two guys are in competition every second of every day. And they're probably tweeting, texting each other or whatever, be like, yeah, well, my stock's down here. But in reality, if I hadn't done my split, Jeff, it'd be worth $5,700 a share.
And that's the truth of it, right? So
I I would guarantee you'd be like, you try splitting your stock and see how much you can regrow it.
Well, let's see what kind of a position in Twitter Bezos is going to take tomorrow, right?
Oh, I know.
9.3%.
Yeah. I think that's really where I mean, that in some level, you don't get to the level that either of these guys are without being one competitive and totally egocentric on every
they have to be.
framework.
Absolutely have to be.
He owns 9.2 what? Is there any decimals beyond that?
One share more. This is one share more. Right?
I don't even like Twitter. Resurrect Parler.
There's going to be lots of options.
So, so there's the mandatory corporate actions we're talking about. We have the stock splits, the reverse splits. There's mergers and acquisitions. These companies, lots of them go through. Microsoft is buying out Activision this coming year. That's been a big. There's all sorts of rumors around, insider trading issues around that a little bit. But I was listening to an article, listening to a show on that the other day. But the idea that two companies, they're absorbing or merging or coming together, or somebody's buying them out. It's a board decision. So your real opportunity is to vote in the board members that you believe to be the case.
Yeah, somewhere along the way, this behaving in the interest of the shareholder is not quite fictional, but the reality is you've elected people to make those decisions on your behalf, and you just have to trust that they do so. And if you don't like it, you sell the stock.
Yeah, so we're going to take a quick break here. You're listening to Money on Tap. You can reach us at 855-226-8551. As we had mentioned earlier, if you have any show ideas and you're looking for answers to questions maybe that we haven't quite entirely covered, feel free to email those at info@yourmoneyontap.com. Or if you have questions on your own portfolio, you want to sit down with us and have a free evaluation and kind of see where you're at and if things make sense, or you have questions on how what we're talking about applies, come in, free consultation. We'd be happy to sit down and go through that with you. We'll be right back. We're talking about stocks you buy and what they do. We have quite a few things coming up on trying to educate you around, the various activist and IPO and dividend items that we're going to have coming up here in just a few minutes. Stick with us. See you in a second.
If you're listening today and, your questions are outside the box of estate planning or financial planning or any number of the pieces that we kind of traditionally talk about, don't forget that Brayshaw Financial offers auto, home, and business insurance. And we have an entire department that handles all of that for you. Give us a call at 855-226-8551 and be happy to take care of those needs for you. Or email us at info@yourmoneyontap.com.
Now back to Money on Tap with Ben and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. Hey, you're listening today. We're talking about stocks you buy and what they do. And there's just a lot of question about, and we did a show years ago, Dan, on jargon and all the different pieces of like lingo in our industry that's just so confusing to the average investor who says, I just want to own Tesla. I just want to own Apple. And those are really, we definitely encourage a buy and hold mentality. And those are types of companies that you can potentially do that with. Their history has said that at least. But whether or not, that's what you want to do or that's, where you want to go, cost and expense is really a big focus. And sometimes trying to get your exposure in those spaces, it becomes difficult at their current pricing and values. And we were finishing up with stock splits and reverse splits, and we were talking about some of those pieces. I think one of the things that we didn't quite kind of come to the cusp on the end of, I think, was talking about Apple. Apple's had lots of splits. And they've continued to grow from that. It's kind of it's almost seen as the blue chip of the tech world. I would say people pile into it in safety and hope that it's not going anywhere. They've just got crazy amounts of cash, and in 2020, Apple in July, like in the middle of our pandemic, right? July 2020. It did a 4-to-1 split. It was about $500. It split to $124 a share, and today it's at $176-ish or something like that. And that's a $704 or basically a 40% increase in its value. Pretty substantial. I think there's something to be said about that, and to look for, because splits tend to be in the positive scenario for people. They don't usually split without it. There's rumor that Chipotle may split again, and then Tesla may split again. I think those are things that, I would keep yourself aware of and figure out whether or not you want to carry through on that split or not, and being aware of these corporate actions. So those are some of the mandatory corporate actions. As we finish this up, we're going to talk a little bit about the mandatory corporate actions that have some choice. That's kind of like our second realm. This is when the board decides, hey, listen, we're going to do a couple different things. We're going to give you some sort of either buyout or whatever, and you can take it in dividend, or if they're doing a company split of some sort, maybe splitting off a company, will give you shares of another company. There's a number of different areas in that space that are really, I think, very interesting. Like, for instance, Dan, I mean, how many times have you gone to your stock portfolio and you're like, where did this company come from? I didn't buy this stock, and it's 2 shares.
Yeah, no, you find these kind of oddball surprises, right, in the list of shares, and that's exactly what happens. You see a ticker you're not used to, and I'm like, well, what is that? And that's what happens when one publicly traded company spins off another, right? So by nature of the fact that you were a shareholder there, and the company's going to willfully reduce the value of the company or create a separate entity, well, you're entitled to participate in that, right? So when they spin that company off or divide it in two, or take one certain segment of a larger business and take that separately public, if you own that parent share, for lack of a better term, you will get some degree of value in the new entity, whatever that is.
And sometimes they'll sell off portions of their company to somebody else who's a private company, and they'll return you money in return.
Push through cash.
Yeah. And I think that's interesting because a lot of people figure, like, what happened to this? Why did the stock value go down? Or where did this stock come from? We get calls like that from time to time, and honestly, they're more nuisances than anything else. They don't tend to usually be. I honestly, when that stuff usually happens, unless I'm getting cash, I usually see that as they're spinning off something that's not profitable, and they want to get it off their books and create another set of books. That's how I look at it.
J&J is going through that with some of the lawsuits, and something to keep in mind there too.
Yeah, absolutely, and a very good point. Then there's the voluntary corporate actions. It's kind of our third point on the corporate action space. The voluntary corporate actions, these could be anything from voting for board members to any sort of choice of what you want to do. They're pushing something out that's a decision you get to make. And this is kind of an interesting space because voting for the board is significantly more important than people realize. Proxy votes, like you can vote for the board members, or you can decide not to vote and allow whatever the clearinghouse is or whoever the representative is that's holding your shares to make a vote as they see with whatever their move is as a general decision. And usually they move with the board's opinion. But I think it's really important that people understand that voting for people on the board is really important because it can have a really adverse effect potentially on a stock. Now, that doesn't mean that, or I would say a stock or a company even. One of the things that we have recently had in our past, and we talked about this on the show earlier, not today, but months ago. But Exxon had was it a hedge fund company or a private equity? Yeah. Engine number 1, that's the name of it. They had a 0.02% stake in Exxon. But then with that stake, they convinced BlackRock and Vanguard and State Street, who held 20% of Exxon, to move with them on Exxon to push Exxon to get 2 of their two board voting seats available to them in the vote process. They had to concede that. And then on top of it, push the company to really focus more on green energy, which has never really been Exxon's forte, but it hasn't really been out of their purview either. Actually, I mean, there's been a number of arguments that they've been doing a lot of good in that space.
Yeah, they've been an energy company, right? That's become kind of the new terminology as opposed to an oil company, right? So you got to kind of move with the times there. But it was a blatantly public and not even subtle play by them to lobby their way into these seats, specifically with the intention of moving the company green. Yeah. I mean, it's really amazing that they went from 0.02% of the shares to 2 seats on the board.
Yeah.
I mean, that's an incredible rise to take some power and really, forever influence the future of the company.
Yeah, absolutely. And I mean, you think about that, and then you think about Elon Musk's 9.2% ownership. I think he's going to have some. I mean, just looking at 0.02% having that much sway, think about what 9.2% is going to do to a company like that.
No, it's a tremendous stake. I mean, it's shocking he's able to do that, quite honestly.
Yeah. I am shocked that stock didn't rise to $100 a share while trying to do that either. It did grow considerably, but yeah, that's interesting. I think the thing is that people don't really understand all of the different moving parts of these corporate actions that are happening at these companies. I mean, we're not part of the day-to-day. We're investing in companies that we believe in. I hate to quote Jim Cramer. He's not necessarily my favorite guy, but he always says, buy something you know. And I think that's a valid point. I mean, don't give him credit, but I think that's a valid point. I'm sure someone said it long before him, and I'm quoting that guy. So, but I think the thing that's funny is that if you don't know it, you're never going to be able to really ascertain when you should sell it, right? Like you got to know what you own, know why you own it, know what you purchased it at and why you thought it was a deal and what you're going to sell it for.
Yeah, go into it with a game plan. What's the exit strategy? At what point is it good enough? And you'll be all happy and lucky to get there. But when you do, make that move.
And I think one of the things, as financial planners and working with people in the financial planning space, I mean, we trade stocks literally probably every day. But when it really comes down to the entire concept of financial planning, people get tied up to their stocks. Like I've owned these stocks for so long. And for our listeners who are trying to figure out how to transition to retirement, I always tell people there's two phases, Dan. There's the accumulation phase and then there's the distribution phase. And people think of that as kind of like the light switch between acquiring and accumulating their assets, and then they hit retirement and they flick the switch and they go to distribution. The problem is the investments you use for accumulation are not the same investments you use for distribution most of the time. They can play a part. They can be part of the story, but in their entirety, you should be making a change to meet the new needs. And a lot of people aren't prepared for that. People really aren't, able to make that kind of conscious decision, and they're just too emotionally connected to everything. And stocks are one thing that people get extremely emotionally connected with.
Very easy to fall in love with them. There's no doubt about that. But, the stocks that you would want to acquire and hold in the accumulation phase, they're going to be more volatile. They're going to have more growth potential. But keep in mind, that risk is being supported by the fact that you have income.
Right.
The day you no longer have income, you can't support that risk anymore.
So true. And people they can't grapple with that right away. And it's usually not until a failure occurs that they come running for help. And so, my two cents advice before we take our break and come to our final part here is, if you're doing well, you've made good money in the market and you're ready for a retirement, come to us. We can make it that much more successful now when your portfolio is flourishing from a recent, recovery in this last few months and the last, couple of years and, kind of getting through this whole, let's bridge the gap. Let's make sure that, the next tranche of market downturn or the next war or the next, COVID outbreak or whatever doesn't send your portfolio south and you're trying to figure out where do you take money, or when the Fed, raises rates, how do you do this? Or when, taxes go to 50% and everyone's laughing, they're never going to 50%. Trust me, they're going, and they're going up, and they're going to go up heavy over the next 15 years. When those taxes go that way, are you prepared to figure out how to get the most money in your hands after taxes? Is that what you've done? Those are the things that we need to cover. You're listening to Money on Tap. I'm Ben Brayshaw here again with Dan Michelon. Thanks for sticking with us. As we close out today's show in the next few minutes, I think we're going to cover a couple of really kind of key points. But in the meantime, our number, 855-226-8551. And you can email us at info@yourmoneyontap.com. Dan, so, as we kind of jump into this, we have two items that we want to cover. We want to talk about dividends, and what did you want to cover? Last piece.
We're talking about the dividends and the stock buybacks.
Yeah.
Right. Why a company would choose to buy its own stock off of the street. So jumping right into that, I guess we'll start with that. We'll work our way into the dividends. There's been a couple examples lately. Lululemon just bought 2.1% of their share float for $1 billion. And that just happened last month. Under Armour recently bought 6% back. Macy's 28.9% back. So this is happening more and more. And, really what that has to do with is, these companies end up with cash on the balance sheet for whatever reason, stellar sales or lower costs, and they have an opportunity to either invest in a new product, hire more people. They just have options of what a company may do. But one of the rights of the board of directors would be to initiate a buyback. Now, that's interesting on a couple different levels. And the one indicator to an investor like myself and like you guys listening would be to, deeply consider, considering that the board of directors knows more about what's going on in the internal workings of the company and they're willing to spend their cash buying their shares back off the street, that's got to be a real bullish indicator. I mean, they believe something good's about to happen.
Yeah, they think, hey, listen, our stock's cheap. We should buy it up now.
Right.
Versus buying it up some other time. Like, people don't understand how valuable we are. So clearly, if we buy our stock now, stocks rise based on how many people are buying it versus how many people are selling it, right? So I think one of the things that, is exampled here pretty clearly is that Lululemon, for instance, they did that $1 billion buyback. They went from $344 a share to $373. Under Armour, they went from low 16s to mid $16 a share. Macy's went from $24.42 to over $25. Twitter, $4 billion market cap, and a little Elon Musk went from 37 to 52. So
he helped out push that one.
He pushed that one. Yeah, he pushed that one well. I think the thing that is really important about understanding. I mean, Bristol Myers is BMY is doing a big share buyback this whole year, which I've been long that stock for a little while, and looking to say, hey, maybe I'm looking to get out of this thing. I don't know. It's it's one of those things, but I know that ultimately it's got a interesting dividend. I think they're buying the company back. I'm saying to myself, hey, there might be an opportunity there. So understanding share buybacks and how they might play into a portfolio is important.
Yeah, and on the flip side of that, we covered it last week and don't want to spend too much time on that, but interesting what AMC did, right?
Yeah.
They had all this cash on the books. Did they reinvest in themselves?
Yeah.
No, they bought a gold mine.
It's one of those things. And, it's interesting when you start talking about dividends, you start talking about yield and the idea that these companies are paying you every year some level of return. Now, there's the kind of the aristocrat stocks, and those are the stocks that have long history of raising their dividend year after year after year. And, dividends by no means are a reason to buy a stock. Like, it doesn't mean that they're going to continue paying that stock. It doesn't mean it's a good company. It doesn't mean that some companies actually borrow money from banks to pay out dividends, which is really not necessarily the most healthy thing, but they'll use those. So dividends don't necessarily mean a company is really strong and vibrant. But if you start looking at cash flow and their free cash flow and what's going on there, you can start really evaluating whether they can afford the dividend. But I really like dividend stocks. I like receiving money. I pay taxes on it, but I like receiving money because I watch those dividends buy more shares for me.
Now, this is an example, though, of a corporate action with choice, right? Mm-hmm. So when a company declares a dividend, and the process goes like this, they'll have a declaration date where they'll make public the intent to pay a dividend. They'll have an X date, which what that means is everybody that owns the stock on that day will receive the previously stated dividend, and then they have the pay date,
right?
And that's when you actually get the dividend. But the choice we have in that as an investor is you can choose to take that dividend either in stock or in cash.
Right.
And so for us, for the folks that we advise through retirement,
yeah,
we use that cash portion, that cash option of a dividend to produce income.
Yeah, absolutely. And I think there's going to be more and more demand for, strong dividend yielding stocks. We've talked about that over and over on this show. It can just be with the amount of baby boomers retiring, people looking for all sorts of either flexibility or types of income, anything from, we talked about annuities, we've talked about, CDs, we've talked about dividend stocks. I mean, it's just, you can do bonds. There's lots of ways to get income. But how you translate that into a financial plan is really what's important. The other thing that people don't necessarily understand is that, when you put your money into, high yield stocks or dividend based stocks, we don't care if the stocks go down because I'm buying more stocks, right? I'm buying more stocks producing a higher yield. So as the stock value price goes down, they pay you the same yield. They pay you the same amount of money based on how many shares you own, not based on what the value of the share is. So if you own more shares as it goes down, you're buying more shares down there, you're actually getting a higher yield as the stock price goes down. Now, if you're picking these things up for retirement, you're not going to really care where the stock price is going. So if you're taking some out for income and reinvesting others, you're honestly going to be getting more income for those new dollars going in.
Yeah, I mean, ultimately, you're banking on that at some point the stock increases and grows your overall value, but you can be patient with that because you're not going to sell the stock that day. You're just going to collect the cash.
Yeah, and the more it goes down and the more that cash is buying more shares, the more income you're creating. It becomes a money run, which I like. So anyways, you were listening to Money on Tap. That's going to wrap it up for us today. We thank you for joining us. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. This is Ben Brayshaw and Dan Michelon. We'll catch you next week. You have a good one.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.